Let's get right into it. At the very heart of how institutional markets really move, there's this constant rhythmic dance happening between two fundamental states. And if you can learn to see this rhythm, you can unlock some of the cleanest, most logical trade setups you'll ever find. Welcome to AI Explains ICT. In this video, we're doing a deep dive into the concepts from Core Content, Month 7, Episode 6. And trust me, you're going to want to grab a notebook for this one because we are building a framework you can literally apply to your charts today. The whole idea is simple, but it is so powerful. Price is almost always moving from a discount to a premium, or from a premium all the way back down to a discount. So here's our game plan. First, we'll break down this fundamental duality of the market. Then, we're going to learn how to read the institutional map using something called PD arrays. After that, we'll zero in on the single best time frame for this kind of analysis, walk through a real-world case study to see it all click, and finally, we'll cover how to time the weekly low for those high-probability entries. Okay, let's start with the big idea, the lens you need to see everything through. At any given moment, within any trading range, the market is either at a premium or a discount. That's it. It's always one or the other.
Think of it like shopping. A premium? That's when something is overbought. Prices are high, they're expensive. This is where institutions are looking to sell or get rid of their long positions. A discount, on the other hand, well, that's the bargain bin. It's an oversold condition. Prices are cheap, making it the perfect area for those same institutions to start buying. The whole game is just about anticipating the move from one state to the other.
And this right here, this is basically the institutional treasure map. It's called the PD array matrix. It lists out all the specific reference points that smart money uses in both premium and discount zones. Now, these aren't just random support and resistance lines. They're the actual footprints left by institutions, telling us exactly where price is most likely to have a reaction. Okay, so we know the what. The market moves between premium and discount. Now, let's get into the how. How do we actually find these zones and, more importantly, the key levels within them on our own charts? Well, we do it by hunting for these PD arrays, which, as you know, stands for premium/discount arrays. These are those specific institutional reference points we just saw in the matrix. We're talking about things like fair value gaps, order blocks, breakers, you name it. These are the locations where we can expect a reaction because it's where institutional order flow has left its mark. But before you even think about looking for those PD arrays, you have to do one thing first. And as ICT says, the trading range you're looking at, that is your master blueprint. Everything, and I mean everything we're about to do, flows from first identifying the dominant range that price is currently stuck inside of. And this leads us to our first real practical step, grading the range. It's actually really simple. You go to a higher time frame chart, say the daily, and you find the highest high and the lowest low of the current major price swing. That's your range. The top half of that range, that's your premium zone. The bottom half, that's your discount zone. And just like that, you've got institutional context for every single move. Now that we've got our big picture blueprint from the daily chart, we need a time frame to actually hunt for setups. For this short-term trading model, what ICT calls the one-shot, one-kill approach, our absolute go-to tool is the 4-hour chart. So, why the 4-hour specifically? Well, it's the absolute sweet spot. It perfectly frames the entire weekly range so you can see each week's story play out. It also shows those key PD arrays from the daily chart with beautiful clarity. But most importantly, it filters out all the crazy noise from the lower timeframes, making it the perfect canvas for finding that one clean, high-probability setup each week. As you start grading your ranges and marking your PD arrays on the 4-hour chart, you're going to notice something incredible. Price doesn't just move randomly, it moves with serious intent, almost like it's being pulled from one of your levels to the next. ICT calls them magnets or mile markers for the algorithm. It'll reach for one, do its business, and then immediately take aim at the next logical level. All right, theory's great, but let's see how this all comes together in the real world. We're going to walk through a bullish week step by step and watch price move from a very clear discount all the way up to a premium objective. So here's our starting point. Look where this huge up move starts. It's not some random spot. Price had traded all the way down into a deep discount relative to the larger range. We are clearly oversold, and this is exactly where we should start looking for institutional buying to step in. Now watch how this move builds. Price doesn't just turn on a dime anywhere in that discount zone. No, It trades down specifically into a fair value gap, a key institutional PD array. This spot right here is the launch pad. This precise level is what provided the fuel for the entire weekly move higher. And this just brilliantly shows the destination. After launching from that discount fair value gap, where does price go? It reaches up with purpose and targets a logical PD array in the premium half of the range. See, it moves from discount to premium. The weekly objective is complete, and the entire move was perfectly framed by these institutional reference points. That case study is awesome, right? But it brings up the most important question for any trader. It's not just where to trade, but when. I mean, knowing that price is in a discount is only half the battle. We also need a framework for timing our entry. So, the big question is, how do we anticipate the low of the week with a higher degree of probability? When should we be the most alert, the most focused on finding that perfect entry? Well, ICT provides a simple but incredibly effective timing model for this. In a bullish market where you expect price to move from discount to premium, you should anticipate the low of the week to form on Monday, Tuesday, or Wednesday, MTW. Those are your highest probability days to see the weekly low get put in before the big expansion move takes off. And if we look back at our case study, what do you know? This is exactly what happened. In that first week, the low formed on Tuesday after dipping into that daily fair value gap, and in the week right after, the low formed on Monday at a key equilibrium level. The TMW principle played out perfectly, offering these prime entry opportunities early in the week. And here's our wild statistic that really drives home why this timing is so critical. ICT has observed that typically 30 to 50%, that's almost half, of the entire weekly range is already done by the time the London session closes on Wednesday. So what's the clear takeaway from that? It's simple. If you've missed an entry by Wednesday, you have to be super cautious about chasing the price on Thursday or Friday. With so much of the move likely already over, you risk getting what ICT calls pip drunk, forcing a late trade when the real, juicy opportunity has already come and gone. And that really brings us to the end. The framework is so simple and elegant. Identify the range, figure out if you're in a premium or a discount, anticipate the move to the other side, and then hunt for your entries early in the week. So the only question to leave you with is, how are you going to use this premium versus discount lens on your charts this week? Hey, if you found this breakdown helpful, a like and subscribe would be absolutely amazing. And if you have any questions at all, drop them in the comments below. A real human will get back to you. Thanks so much for watching and safe trading out there.